In this video, we're going to break down one of the most important concepts in price action and smart money trading, order blocks. What they are, how they form, why price reacts from them, and how traders use them to align with market direction instead of trading emotionally. So first, we need to understand what an order block actually is. An order block represents an area where strong institutional activity entered the market, creating displacement, momentum, and a shift in delivery. Whether bullish or bearish, the bullish order block is a group of consecutive bearish candles that later gets closed above aggressively by a bullish candle. Meaning, price was previously delivering downward, then buyers entered the market with enough strength to close above that bearish delivery. And that shift in delivery is what forms the bullish order block. The same concept applies to bearish order blocks. A bearish order block is a group of consecutive bullish candles that later gets closed below aggressively by a bearish candle. Meaning, sellers entered the market with strong displacement, causing price to shift from bullish delivery into bearish delivery. So now let's understand how we actually define an order block correctly on the chart. As we mentioned earlier, a bullish order block is usually identified as the group of consecutive bearish candles that later gets closed above aggressively by a bullish candle before displacement happens. For example, if price forms several bearish candles during a retracement, then suddenly creates strong bullish displacement upward, those consecutive bearish candles become the bullish order block. And in this case, the order block can be defined using the entire bearish candle group before displacement. And we can also refine it to only the final bearish candle before displacement if those candles contain large imbalance. And the same concept applies in bearish conditions. A bearish order block is usually identified as the group of consecutive bullish candles that later gets closed below aggressively by a bearish candle before bearish displacement occurs. For example, if price forms several bullish candles temporarily, then aggressively collapses downward afterward, those bullish candles become the bearish order block. And just like bullish conditions, the entire bullish candle group can initially define the bearish order block. And we can also refine it to only the final bullish candle before bearish displacement. So, because strong displacement usually reveals aggressive participation inside the market. And that is why many traders pay close attention to these areas when price revisits them later. So when price revisits that area later, the market often reacts from it again. In bullish conditions, price may return to a bullish order block, find remaining buy-side interest inside that area, then continue expanding upward. And in bearish conditions, price may revisit a bearish order block, find remaining sell-side interest, then continue delivering lower. This is why order blocks often act as reaction zones inside trending conditions. And that is why many traders pay close attention to these areas when price revisits them later. But what makes order blocks important is helping price move efficiently between premium and discount, especially on lower timeframes. Because during bullish market conditions, price does not simply move upward in a straight line. Very often, after bullish displacement occurs, price retraces back into a bullish order block located inside discount, before continuing higher again. And this retracement is extremely important, because it allows the market to rebalance price, fill inefficiencies, and create better positioning for continuation. The same concept applies during bearish conditions. When the market is bearish, price will often retrace upward into a bearish order block located inside premium, before continuing lower afterward. And this is exactly why professional traders pay close attention to the location of the order block inside the dealing range. Because even if the direction is correct, entering from the wrong location can still create poor positioning. Another very important function of order blocks is helping lower timeframe movement align with higher timeframe direction. Because very often, the higher timeframe already reveals the overall market narrative, whether the market is bullish or bearish. But traders still need precise execution areas on lower timeframes. And this is where lower timeframe order blocks become extremely important. For example, if the higher timeframe narrative remains bullish, traders usually focus on bullish order blocks on the lower timeframe. At the same time, they pay attention to bearish order blocks failing to hold price lower. Because the failure of bearish order blocks often becomes confirmation that bullish higher timeframe order flow still remains dominant. The same concept applies during bearish conditions. If the higher timeframe remains bearish, traders usually focus on bearish order blocks on the lower timeframe, while watching bullish order blocks fail to continue price upward. Because alignment between higher timeframe direction and lower timeframe order block behavior is one of the strongest confirmations traders can use inside market delivery. Finally, one of the most important things traders misunderstand is believing that every order block has the same strength. But in reality, some order blocks are significantly stronger than others, and this is where classification becomes important. The first type is the normal order block. This is considered the weakest type, which simply forms by price closing above bearish candles in the case of a bullish order block, or below bullish candles in the case of a bearish order block, without causing imbalance or sweeping liquidity. These order blocks can still work, but they usually lack additional confirmations, such as imbalance or liquidity sweeps. The second type is the middle order block. And this type becomes stronger because it forms with one additional confirmation, either a fair value gap or a liquidity sweep. For example, if price creates a bullish order block while also leaving behind a fair value gap, that increases the probability behind the setup. Or, if price sweeps liquidity before forming the order block, that also strengthens the narrative behind it. And finally, we have the strong order block. This is considered the highest probability type, because it forms with both a liquidity sweep and a fair value gap together. Meaning price first takes liquidity, then aggressively displaces away from the area, while leaving imbalance behind. And that combination often reveals very strong intent inside market delivery. And now let's look at some practical examples directly on the chart. Starting with the normal bullish order block. Here, price forms several consecutive bearish candles, then suddenly, a bullish candle aggressively closes above them, creating bullish displacement. Now notice, this move did not sweep liquidity, and it did not leave behind a fair value gap. So this would simply be considered a normal bullish order block. Now let's move to another bullish example. Here, price again closes aggressively above bearish candles, forming a bullish order block. But this time, the displacement leaves behind a fair value gap, meaning imbalance was created during delivery. So this setup becomes stronger than the previous one, because now we have displacement plus imbalance. And finally, let's look at a strong bullish order block example. Here, price first sweeps liquidity below previous lows, then aggressively displaces upward, breaks structure, and leaves behind a fair value gap. Now this setup contains liquidity sweep, break of structure, imbalance, and strong displacement together, which makes this a strong bullish order block. Now the same concept applies in bearish conditions. For example, price may form several consecutive bullish candles, then suddenly, a strong bearish candle aggressively closes below them, creating bearish displacement. If this move happens without liquidity sweep, and without imbalance, then this would simply be considered a normal bearish order block. But if price first sweeps liquidity above previous highs, then aggressively collapses downward, breaks bearish structure, and leaves behind a fair value gap, then this becomes a strong bearish order block. Because now bearish delivery is supported by liquidity sweep, displacement, structure shift, and imbalance together. But even after seeing these examples, there is still something extremely important traders must understand. This is still not a fixed rule, because trading is not mechanical certainty. For example, sometimes a simple order block like the first example may react perfectly, and price completely respects the area before continuing upward, while another strong order block, containing liquidity sweep, break of structure, and fair value gap, may completely fail when price revisits it. The same thing can happen in bearish conditions as well. A simple bearish order block may hold perfectly, while a strong bearish order block fails completely. And this is exactly why trading is a game of probabilities, not certainties. Because no order block guarantees success every single time. And in the end, everything still depends on overall context. Higher timeframe direction, market conditions, liquidity, and narrative alignment. Which is why professional traders never rely on one confirmation alone. They position themselves around the highest probability scenarios possible. They are constantly looking for confluence. Higher timeframe direction, liquidity, displacement, market structure, fair value gaps, and strong order blocks. Because the more factors aligning together, the stronger the probability behind the setup becomes. But even then, risk management always remains essential. Because protecting capital is more important than any single trade. And once traders truly understand this, they stop chasing certainty inside the market. And they begin thinking logically, patiently, and probabilistically. So if you found this video valuable, make sure to like, subscribe, and turn on notifications for more simple and educational trading content about liquidity, ICT, and market psychology. And if you have any questions or topics you want explained next, feel free to leave them in the comments. See you in the next video.